Imagine buying a stock today and getting a bigger dividend check every single year for the next 50 years. Sounds unrealistic, right? Well, a small group of companies has already done exactly that. They raised their dividends through the dot-com crash, through the 2008 financial crisis, through recessions, wars, inflation, and even a global pandemic. Not most years, every single year. And some of these companies have been doing it for more than 60 or even 70 consecutive years. Today, we're looking at 10 of them. And here's what makes this list interesting. These aren't obscure companies you've never heard of. You probably bought something from several of them this week without even realizing it. Toothpaste, soda, diapers, fast food, even the system that may process your paycheck. But stay with me, because the final company has accomplished something none of the others have. The longest active dividend growth streak of any publicly traded U.S. company. By the end, you'll know which businesses made the list, why their dividends survived crisis after crisis, and which ones might actually deserve a place in a long-term portfolio. Before number one, there's one distinction you need to understand. You've probably heard the terms Dividend Aristocrat and Dividend King. They're not the same thing. A Dividend Aristocrat has increased its dividend for at least 25 consecutive years. A Dividend King, 50 years or more. That's an entirely different level of consistency. And a company doesn't accidentally raise its dividend for half a century. Think about what has to happen for that streak to survive. The business needs enough cash to keep paying shareholders during recessions. It needs pricing power when costs rise. And, most importantly, it needs customers who keep buying even when the economy gets ugly. Because when money gets tight, you might delay buying a new car. But toothpaste, diapers, medication, payroll processing, those don't simply disappear from people's lives. Now think about what 50 years actually covers. Oil shocks, the dot-com boom and collapse, September 2001, the housing crash, the Great Recession, a global pandemic that shut entire economies almost overnight. Thousands of businesses didn't make it through those periods intact. Yet these companies kept sending shareholders checks, and then they increased those checks. That's why these aren't necessarily stocks you buy because you expect them to double next year. You buy them because boring can be incredibly powerful when you give it enough time. And you'll see exactly what I mean with the first company. Quick disclaimer before we start. I'm not a licensed financial advisor, and nothing in this video is personalized financial advice. Dividend yields and payout ratios change over time, so always verify current numbers before making an investment decision. And remember, even a 50, 60, or 70-year dividend streak cannot guarantee another increase next year. Let's start with Procter & Gamble. If you want a textbook example of a durable consumer business, this is one of the easiest companies to understand. P&G owns brands that are so deeply embedded in everyday life that millions of customers buy them almost automatically. Tide, Pampers, Gillette, Crest, Bounty, and many others. The beauty of that business model is that P&G doesn't need to completely reinvent consumer behavior every few years. It mainly needs customers to continue buying products they already know and trust. Repeat purchases create predictable demand, and predictable demand creates the kind of cash flow that can support a dividend through almost any economic environment. Procter & Gamble has built roughly 7 decades of dividend increases. The yield has generally been in the low to mid 2% range, while the payout ratio has often been around 70%. Dividend growth has historically been steady rather than spectacular, and that's really the trade-off with P&G. You're not buying it because you expect some revolutionary new product to suddenly double the company in size. Consumer staples companies rarely grow that way. You're buying reliability. People can delay purchasing a television during a recession, but they still wash their clothes, brush their teeth, shave, clean their homes, and care for their children. That creates an enormous advantage. P&G also benefits from pricing power. If the price of a familiar household product rises slightly, some customers might switch brands, but many will continue buying what they already trust. Multiply that behavior across millions of households around the world, and you begin to understand why these brands have so much economic value. P&G doesn't need the next cultural phenomenon. It needs to protect its brands, manage costs, innovate gradually, and keep customers coming back. Next is Coca-Cola, probably one of the most recognizable companies in the world. Walk into a store in New York, London, Tokyo, Lagos, or almost anywhere else, and there's a good chance you'll see one of Coca-Cola's products. That global distribution network is one of the biggest reasons the company has been able to increase its dividend for more than 60 consecutive years. The yield has typically hovered around 3%, offering investors a combination of current income and long-term dividend growth. But Coca-Cola is much bigger than its flagship soda. Its portfolio includes water, juice, coffee, sports drinks, and other beverage categories. That's important because consumer preferences change. Health-conscious trends have put pressure on traditional sugary drinks, and consumers increasingly want more options. Coca-Cola has spent years adapting rather than depending entirely on one product. Now here's the trade-off. Coca-Cola is not a fast-growth company, and the traditional soda business faces legitimate long-term pressure from changing health preferences. So you're not primarily buying explosive growth. You're buying brand power, distribution, pricing strength, and durability. Remember what happened in 2020? Restaurants shut down, stadiums went empty, cinemas closed. Entertainment venues disappeared almost overnight, taking major sales channels with them. Yet Coca-Cola survived that shock and continued its long dividend tradition. It also made it through the 2008 financial crisis and numerous currency crises across global markets. That kind of resilience doesn't happen by accident. Coca-Cola has built a system where billions of individual purchases, spread across dozens of countries and multiple beverage categories, create an enormous and relatively stable stream of cash. Johnson & Johnson takes us into healthcare, which has a different form of defensive strength. When the economy slows down, people may postpone holidays, luxury purchases, or entertainment. They cannot simply stop needing healthcare. Medication, medical devices, surgery, and essential treatment don't disappear because GDP falls. That is one reason J&D has been able to increase its dividend for more than 60 consecutive years. The company has historically operated across major areas of healthcare, which creates diversification inside the business itself. A difficult period in one segment doesn't automatically threaten the entire company. Medical device demand may behave differently from pharmaceutical demand, allowing one part of the company to help offset weakness somewhere else. The dividend yield has generally been around the 3% range, with the payout historically remaining manageable. But there is a real risk worth understanding here: litigation. Johnson & Johnson has faced significant legal exposure over the years involving certain products. That's not something investors should dismiss simply because the dividend history looks impressive. And this brings up an important lesson about every company in this video. A long dividend streak does not mean a business has no problems. It means the business has historically been strong enough to survive those problems. J&J's scale, cash generation, and diversification have allowed it to absorb challenges that would have seriously damaged smaller competitors. That's what makes durability different from perfection. You're not looking for a company that never faces adversity. You're looking for one capable of surviving it. Now let's talk about PepsiCo, because this company is often misunderstood. Most people immediately think about Pepsi versus Coca-Cola. But PepsiCo isn't simply a beverage company. It also owns Frito-Lay, giving it massive exposure to snack foods through brands such as LA's, Doritos, and Cheetos. So when you own PepsiCo, you're essentially getting a huge beverage operation and a huge snack food business inside the same company. That combination has supported more than 50 consecutive years of dividend increases. Its yield has often been in the mid-3% range, and the payout ratio has frequently been around the low 70s. That gives income investors a respectable starting yield, although a higher payout ratio naturally leaves somewhat less room for aggressive increases. PepsiCo's challenge is that health-conscious trends don't only affect soda. Consumers are also becoming more aware of sodium, calories, ingredients, and highly processed foods. That means the snack business has its own long-term adaptation challenge. PepsiCo has been changing its portfolio, but this is an ongoing process. The interesting question isn't simply whether Pepsi is better than Coca-Cola. A better question is which business structure you prefer. Coca-Cola offers concentrated exposure to an enormous global beverage ecosystem. PepsiCo spreads its consumer strength across drinks and snacks. Those two categories don't always move together, creating a modest amount of diversification inside one stock. And when you're holding something for decades, having several engines supporting cash flow can be valuable. Colgate-Palmolive is another company built around a habit most people never stop to think about. Toothpaste is not exciting. That's exactly the point. Colgate controls an enormous share of the global toothpaste market, roughly 40% by some estimates. Think about what 40% means in a product category used by billions of people. In many countries, Colgate isn't simply another toothpaste on the shelf. It is the brand consumers recognize first. That category dominance has helped the company support more than 60 consecutive years of dividend growth. The yield has generally been in the low 2% range, which is lower than several names on this list. Investors have historically accepted that lower yield because of Colgate's stability, brand recognition, and enormous international reach. But international exposure cuts both ways. A significant majority of Colgate's business comes from outside the United States, meaning currency fluctuations can affect reported earnings. Emerging market conditions matter too. Inflation, political instability, currency depreciation, and economic weakness can all create pressure. At the same time, that global presence means Colgate isn't dependent on one country for growth. Its deeper advantage is pricing power. When you dominate a basic category, you can often raise prices gradually without losing a large percentage of customers. A few cents added to something purchased by millions of households can become meaningful very quickly. There is nothing exciting about toothpaste economics, but sometimes the least exciting businesses are the ones quietly producing cash for shareholders year after year. Kimberly-Clark takes us into another group of household essentials: Huggies, Kleenex, Scott, Cottonelle, Depend. These aren't products customers buy because they're suddenly fashionable. They are products people restock, and that recurring demand has helped support more than 50 consecutive years of dividend increases. Kimberly-Clark has also historically offered a higher yield than several of the other companies we're discussing, sometimes approaching the mid to high 3% range. That makes it particularly interesting for investors who care about generating income today rather than simply maximizing dividend growth decades into the future. But that higher yield comes with challenges. Paper and tissue products require pulp, energy, manufacturing, transportation, and packaging. When those costs increase, margins can get squeezed quickly. Kimberly-Clark's brands give it some pricing power, allowing management to pass part of those increases on to customers. But there is always a limit. Consumers will tolerate only so much before they start considering cheaper alternatives. That's why dividend investors should never evaluate a company based on yield alone. A 4% yield isn't attractive if the company cannot afford to maintain it. The real question is whether cash flow can continue supporting the dividend through inflation, recessions, and changes in input costs. Kimberly-Clark's multi-decade record suggests management has historically navigated those pressures successfully. Now we get to McDonald's, and this business is much more interesting than simply burgers and fries. One of the most important pieces of McDonald's business model is real estate. The company owns or controls many of the properties underneath its restaurants, while franchisees pay rent in addition to royalty fees. That means McDonald's is not just participating in food sales. It has a recurring economic relationship with thousands of franchisees and valuable property locations around the world. This creates a business structure that most restaurant competitors cannot easily replicate at scale. The yield has often been in the low 2% range, and McDonald's has built a remarkable multi-decade dividend growth record. There is still a clear trade-off. Eating at a restaurant is more discretionary than buying toothpaste, medication, or toilet paper. When consumers come under financial pressure, they can reduce restaurant visits. McDonald's also has to deal with changing health preferences, labor costs, competition, and evolving dining habits. But the franchise model creates a level of resilience that a purely company-operated restaurant business doesn't have. Think about McDonald's almost as two businesses operating together. There is the restaurant brand customers see, and underneath it is a franchise and property system creating recurring revenue. That second layer is a major reason the company has been able to remain so durable. Sometimes the most important part of an investment isn't the product sitting in front of the customer. It's the financial machinery underneath it. Automatic data processing, better known as ADP, might be the least obvious company here. Most people have never thought about payroll processing as an investment, even though ADP may have touched their own paycheck without them realizing it. Businesses need payroll systems, whether the economy is booming or struggling. Employees still need to get paid. Taxes have to be calculated. Records need to be maintained. Human resource systems still have to function. That recurring demand has helped ADP build more than 50 years of dividend increases. The yield has generally been around 2%, which is lower than some of the consumer staples companies, but ADP brings something different to the table: sticky recurring revenue. Once a company integrates payroll and HR systems into its operations, switching providers can be a major inconvenience. Imagine running payroll for thousands of employees and deciding to replace the entire system just to save a little money. The potential disruption can outweigh the benefit. That creates switching costs and helps ADP retain customers. It also means ADP is one of the few companies on this list primarily selling a service rather than a physical product. But there is a risk. ADP's business is tied to employment levels. A severe and prolonged increase in unemployment can reduce payroll activity and pressure revenue, so it isn't completely recession-proof. Still, the essential nature of payroll and the difficulty of changing providers give the company a level of resilience many other service businesses would love to have. Genuine Parts Company may be one of the least recognizable names on this list, but its dividend history is extraordinary. GPC distributes automotive and industrial replacement parts. It's not glamorous. It doesn't generate flashy headlines, but it does something essential. It helps keep cars and industrial equipment operating. And there is a fascinating recession dynamic here. When families become financially stressed, they may postpone buying a new vehicle and instead repair the one they already own. That can keep replacement parts demand surprisingly resilient even while new car sales are falling. Genuine Parts has built roughly 7 decades of consecutive dividend increases, putting it among the longest active streaks in the market. The yield has often been around 3%, but GPC is still a distribution business, and distribution businesses naturally operate with lower margins than software or pharmaceutical companies. Growth tends to be slow and steady. Again, that isn't necessarily a weakness if your goal is durability. Genuine Parts has evolved from a primarily automotive parts distributor into a broader industrial distribution company while continuing to reward shareholders. Think about what it has survived: recessions, oil crises, inflation, technological change, shifts in transportation, and dramatic changes in the American economy. Through all of it, vehicles and industrial machinery kept needing replacement parts. Sometimes the strongest investment thesis really can be that simple. And now we arrive at American States Water. If the other dividend streaks sounded impressive, this one takes things even further. American States Water has increased its dividend for more than 70 consecutive years. And the investment logic behind the business is almost painfully simple. Water is not optional. Consumers can cancel streaming subscriptions, delay vacations, postpone buying a car, stop going to restaurants as often, and cut countless other expenses. They cannot simply stop using water. That gives a water utility one of the most dependable forms of underlying demand imaginable. The yield has generally been in the low to mid 2% range. That's not huge, but investors have historically been willing to accept a lower starting yield in exchange for extraordinary reliability. Of course, utilities come with their own risks. American States Water cannot simply decide to dramatically increase prices whenever management wants more revenue. Utilities are heavily regulated, and rate increases generally require regulatory approval. That can constrain growth. The company also has meaningful geographic concentration in California, creating exposure to regional regulation, drought conditions, and other local risks. But the streak itself remains remarkable. More than 70 years, means the company has continued increasing its dividend across generations of shareholders, management teams, political administrations, economic cycles, inflation regimes, and financial crises. That isn't a marketing statistic created by a clever advertising department. It is a track record built across most of a human lifetime. Now step back and look at these companies together. They operate in very different sectors: household products, beverages, healthcare, snacks, restaurants, payroll services, replacement parts, and utilities. But they share one important characteristic: their underlying demand is difficult to eliminate. People still need basic household goods during recessions. They still need healthcare. Businesses still need payroll. Cars still need replacement parts. Homes still need water. That does not make any of these companies invincible, and it certainly doesn't mean you should buy them at any price. Valuation still matters. Debt still matters. Competition matters. Regulation matters. Management matters. But a long dividend record gives you evidence that the company has repeatedly generated enough cash to continue rewarding shareholders through difficult conditions. This is also why you shouldn't expect these stocks to make you rich overnight. Dividend investing is sometimes presented as though buying a few high-yield companies immediately creates financial freedom. That's not how it works. The real power comes from compounding over time. You own shares. The company pays you a dividend. That dividend may increase, you reinvest it, and buy more shares. Those shares generate additional dividends. Repeat that cycle for 10, 20, or 30 years, and small increases can eventually become meaningful. Time is doing much of the work. That's why a boring business can sometimes be more valuable to a long-term investor than an exciting business constantly chasing the next trend. And this is where you have to separate dividend history from blind loyalty. Every company on this list has risks. Colgate has currency exposure. American States Water has regulatory and geographic concentration. McDonald's is more exposed to consumer discretionary spending. Kimberly-Clark deals with input cost inflation. Johnson & Johnson has litigation exposure. ADP is connected to employment levels. PepsiCo and Coca-Cola face changing health preferences. Procter & Gamble has to maintain brand power and pricing strength. Genuine Parts operates in a relatively lower margin distribution business. A decades-long dividend streak does not erase those risks. It simply shows that these companies have historically managed their challenges without abandoning shareholders. So here's the bigger lesson I want you to take from this video. A long dividend streak should not be the end of your research. It should be the beginning. Whenever you see a company that has increased its dividend for decades, ask why. Is demand essential? Does the company have strong brands? Can it raise prices without losing customers? Are switching costs high? Does it produce enough free cash flow to comfortably fund the payout? Is the balance sheet healthy? How much debt does it carry? Could the company still fund the dividend during a serious recession? Those questions tell you much more than simply looking at the yield displayed on a stock screen. Here's a useful exercise. Pick just 2 or 3 companies from this list rather than trying to analyze all 10 at once. Look up their most recent dividend announcements. Check the payout ratio. Look at free cash flow. Read their latest earnings reports. Check their debt. Then ask yourself one simple question. Can I realistically imagine people still needing what this business sells 20 years from now? It's a surprisingly powerful filter. Because if you cannot explain why customers will still need the product decades into the future, a 50-year dividend history alone shouldn't convince you to own the stock. And now I want to hear from you. If you could choose only one of these companies and hold it for the next 20 years, which would you pick? Would you rather own the company offering the highest yield today, the business with the longest dividend growth streak, or the one you believe has the strongest future growth potential? Drop your choice in the comments and tell me why. I read the comments, and they genuinely influence the companies and strategies we cover in future videos. And if you enjoy breakdowns like this, subscribe, because we're going to keep looking at businesses that quietly compound wealth while everyone else is chasing whatever happens to be exciting this week. One final reminder before we finish. None of this is financial advice. Always do your own research or speak with a qualified financial professional before investing your money. A 50-year dividend growth streak is impressive, A 60-year streak is remarkable. More than 70 years is almost difficult to comprehend. But the real challenge for an investor isn't simply identifying the businesses that successfully increased dividends in the past. The real opportunity is figuring out which companies have the balance sheets, competitive advantages, products, management discipline, and customer demand necessary to keep doing it in the future. Because past consistency gives you evidence, but future cash flow is what ultimately pays the dividend. And when you find a business capable of combining both, that's when boring can become incredibly powerful.